Hi, my name's Aaron Curry, and today I'd like to share with you and tell you about the unholy trinity of risks that's going to cause the 2020 house price crash. If you're an educated, experienced property investor, this is going to be the best time in over a decade, since 2008-9, to build your property portfolio. The challenge is if you're an unexperienced investor without the right education, this is probably the most dangerous time to build your property portfolio. And that's why I'm recording this video series, so I can share with you how to safely and securely build a property portfolio in the best time in over a decade, in this coming house price crash. And the thing that I want you to get is that I can show anybody, I can prove to you, in fact I'm going to prove to you in this video series, how anybody can build a portfolio that makes them £50,000 a year of passive income within the next 2 years, regardless of your starting point, provided you have the right education, the right support, and the right accountability. Now, how do I know this? How do I know this is true? If I take you back to when I started my property journey about 20 years ago, it started literally with a book. I got given a book called Rich Dad, Poor Dad by Robert Kiyosaki. It's a brilliant book, you may or may not have heard of it. And I read the book, I was given it by a great mentor of mine, read the book. And if you know the book, you'll know it's a high-level concept book. It doesn't give you the nuts and bolts and detail, but it's a high-level concept book. So I read the book and I'm all excited. I'm like, I need assets, I need to invest. This is brilliant. And I'm looking around for someone else I know with money. Back then, I'd not made a lot of money. In fact, in the job I was in, I'd made just £2,000 in the last 6 months in this new job. And it wasn't going well. So there's no money there, but I'm excited about property. And I managed to find somebody to work with. It was a guy called Mark. I know him really well now. He was my next door neighbour from over the fence. And Mark says he'll put the money in and I'll put the time and effort in, and together we'll build a property portfolio. The challenge is I get the concepts. I know the concept is right. I'm on the right path, but I don't have the detail. I don't have the skill to deliver. So I start using Mark's money. I start growing a portfolio for our future. And guess what? I walk into problem after problem after problem. I'm talking pretty disastrous problems. I'm talking about a property that I've bought in Leeds Chapeltown, and after a few weeks of owning it, they set fire to it. They have a big drugs party in the property. They set fire to it and it burns down. It burns down. I'm talking about having HMO properties, houses of multiple occupation, and the people in one property are not paying the rent, and then they go to one of my other HMO properties and they smash it up because they fall out with someone in there, and then they come back and smash up this one. So now I've got 2 smashed up HMOs, tenants leaving, no rent coming in. I'm talking about buying deals from property sources. What was a property sourcer back then? I didn't really have a clue, and the sourcer tells me it's this amazing deal at discount and the tenant's going to stay forever. And then I actually go meet the tenant once I've signed and bought the house, and the tenant says to me, yeah, we're staying forever, but we're staying for half the rent that you think we're staying for. And I get out the tenancy agreement that they've tricked them into signing for more money. So they've ripped off the tenant, they've ripped off me, and we're left with the mess. I'm left with a property forever that's losing money. These are just 3 or 4 of the many mistakes I made in those first 10 purchases that cost anywhere between a few £100 and a few £1,000. That was in actual loss money, never mind the opportunity loss, because I didn't buy world-class properties back then, because I didn't have the right education. I had the concept education, but I didn't have the detail. So I've put together this video series because I want to share with you how to safely and securely build a property portfolio at the best time in your future lifetime to build this. Right now, in this coming house price crash that will only last for about 6 months, more detail on that later, this is the time to be buying. And I've put together this series to prove to you and to show you that anybody can build a £50,000 passive income from property within the next 2 years, regardless of your starting point, regardless of the money that you've got to start, provided you have the right education, you have the right training that goes with that education, you have the right accountability and the right support. Those foundations must be in place as well. So we're going to go through this video series, and I'm going to start now by explaining about this unholy trinity of risks. Okay, the UK, one of the UK's chief economists, quoted that quote, unholy trinity of risk. That's where I've got it from. What are their concerns? What are the things that they are saying is going to cause the house price crash? Well, there are three main things that they said are going to cause this. Number one, coronavirus, COVID-19. Number two, unemployment, high unemployment that's coming. And number three, Brexit, that we're going to be seeing soon. So let's dive in and look at the detail of each of these so we understand why the market's going to crash, why the market's going to move 5 to 10% downwards in the next 2 or 3 months, and then you can start to make your plans on the back of that for what you need to be doing because of it. So let's have a dive in and look at some of these numbers. There are three things that are going to burst the 2020 housing bubble. You see, in September, house prices rose at their fastest pace in more than 4 years as the property market continued to gain momentum after lockdown. Property values rose by 7.3% in the year to September, according to the latest Halifax House Price Index. That was up from 5.2% in August, and it's the fastest growth since June 2016. It brings the average price of a home in Britain close to the £250,000 mark. And we saw houses selling for more than they were actually listed for in some parts of the country over the summer period, which is unbelievable when you consider that the economy is going in a downward direction and we've got house prices going in an upward direction. So what's caused this mini boom? What's caused this situation to happen? Well, if you think about it, it's not really a surprise. I was predicting this from March, April when we first hit the COVID situation. Because what you've had is you've had a spring period where everybody's locked down. The housing market literally stopped. 450,000 sales were going through at the start of March and they froze. They couldn't go through and complete. Through that spring period, you had all the people that would have normally wanted to move house in spring. They planned to move house in spring of this year. On top of that, you had the people that lived together through lockdown and realised they never want to live together again. They want 2 separate houses now. So they put the house up for sale, they're looking to buy 2 more. On top of that, you've got people that spent lockdown apart, madly in love, and couldn't even spend time together, that said, well, this isn't happening again, we're going to go buy a house. So we come out of lockdown, don't we, in May, June time in terms of the housing market, and suddenly you've got all that built-up demand from before lockdown, plus 3 months of people flooding out wanting to buy houses. So yes, the supply increased because more went up for sale, but the demand increased massively, and this is a supply-demand situation. Yeah? When supply is high and demand is low, prices drop. When supply is low and demand is high, prices go up. In this situation, supply was high, demand was crazy high. With 4 months worth of shopping going on in June in 1 month, or over June, July, like 2 months each. So that's why you saw the market moving in that way. Now, not only were those factors going on, what else happened during that very same period? Well, in that very same period, understandably, the Chancellor said, we've got to keep this housing market moving. We've got to have some good news stories going out there. We've got to not have all areas of the economy failing. So what did they do? They brought in the stamp duty cuts. What did the stamp duty cut do? It basically impacted residential purchases under £500,000. It encouraged first-time buyers into the market. Now's the time to buy. Let's get in. Let's take advantage of this stamp duty cut. And what else did it do? It encouraged house movers. In fact, it was pitched as something to help first-time buyers because it's a vote winner, but actually it was more the house movers that benefited. The person buying their second house or their third house or their fourth house that could make savings up to £15,000. Now, we saw that peak. We saw those figures go up. But guess what? Guess what? When you look at the supply now, when there's some stats from Zoopla, when you look at the people looking for new properties, we saw it peak. We saw it go much above average. Didn't go to double or triple, but it went up. But that line is now downward. And that line and that trend tells you everything you need to know. So in a downward line, there's less first-time buyers now than a month ago, and that's less than a month before that. There's less home movers than a month ago and less than a month before that. It's a downward trend. Those people now are not not going out looking for those properties in the way that they were in the summer months. Now, we haven't yet hit the falling market, and I'm going to come on to why the market's going to fall in just a second. But when you take those actions all together, you've got this stamp duty rush of people buying, you've got this rush of people coming out from the spring, it's really not a surprise, is it, that even though we're in the biggest recession for decades and decades and decades, you know, the market, GDP, fell 20% in quarter two of this year. Now, that's not a surprise, is it? We were all locked down. But 20%, to put that in context, back in 2008-9, GDP, we thought it was a disaster, fell 2.3%. GDP is the gross domestic product. It's the gross output that we're making as an economy. It fell 2.3% back then. It fell 20% in quarter two of this year. So we're in a 10 times worse recession than we were a decade ago, but house prices still going up. Okay, it's not sustainable. So let's move on and look at the three pieces, the three bits of the triangle of this unholy triad that's going to be hitting us, okay, and that's going to cause the crash that I'm predicting of 5 or 10% by the end of the year. Let's have a look at this. Let's look at the first trigger, coronavirus. Coronavirus has changed everything about how we live, hasn't it? It's changed how you spend time with your friends. It's changed when or if you can see your family. It's changed where you eat or how you eat. It's changed how you shop. It's changed whether you can holiday or not, or whether you'll holiday again in the next couple of years. It's impacting everything. The biggest impact, of course, is on the retail sector and the hospitality sector. Massive impact. You know, whether you're at Greg's, where they're losing thousands and thousands of people, Cafe Rouge, Victoria's Secrets, if that's your thing, disappearing. You know, all of these places are having massive impact on where they are and massive impact on their futures. And we all know that there's lots more to come. If you look at the slide that I've put up in front of you now, you've got commercial landlords. So commercial landlords that run the shopping centres, that run the properties that these shops are running out of, that these hotels are running out of. They've been hit extremely hard. They've got unpaid rent bills for commercial premises hitting £4.5 billion. Now, you might think that a big shopping centre is owned by a big faceless corporation, so it doesn't matter. But many of them are owned by pension funds. So the ripple effect is going to affect millions and millions of people and your financial futures. The airline industry is being crushed. And although there are talks of a vaccine, even if it was ready tomorrow, it would still take at least a year for everyone in the UK to receive it. Why would it take so long? Well, look at the basic numbers. To give 2 doses of a vaccine to each of Britain's 53 million adults within 6 months, that would involve 600,000 jabs a day. 600,000! So coronavirus's grip on the economy and how we live our lives is going to be with us, I'm afraid to say. I know this isn't good news, but for at least 6 to 12 months and quite possibly a lot longer. COVID-19 has already triggered a bigger recession, 10 times bigger recession than 2008-2009, at 20% drop in GDP, as I said earlier on. Let's look at the second major impact of this unholy trinity of risks that are coming our way. Unemployment. Unemployment. You've all seen the figures. You all know what's coming. Okay? The figures vary. Depends which economist you listen to. Depends whether you listen to the government. But we're already at 4.1% unemployment. Far higher than the 2016 previous high. Far higher already. And by the way, that data's 2 or 3 months out of date. On top of that, you've got predictions that unemployment's going to rise to 8 to 12% of the population unemployed. That's 3 to 4 million people that want to work unemployed. 3 to 4 million. It's just gigantic. That's 3 to 4 million people that can't move house. That's 3 to 4 million people that can't buy their next property. That's 3 to 4 million people that can't even think about buying the next property. And that doesn't take into account the other millions that are worried they might be on that list. So they're not going to want to look to buy a house. They're not going to want to look to move to their next dream house or take that risk when they're not sure about their current job, when they're not sure about their income, when they're not sure about their business surviving through this pandemic. Okay? You look at companies, Brooks Brothers, for example. Every president since Kennedy, every single president has worn a Brooks Brothers suit for their inauguration. Every single one of them, okay? Brooks Brothers, 2020, they've gone. They're no longer here. They're now a part of history, but they're no longer here. So the big corporations are failing as well as the small businesses, as well as lots of other people. So this unemployment level, which is likely, if we hit 3 million, by the way, or 4 million, that'll be the highest level for at least 40 years. For at least 40 years, it's more than a generation ago since we last had unemployment at that level. This is going to impact on the house prices. What's the third facet? What's the third thing that's going to hit the house prices, as well as coronavirus, as well as the unemployment that's coming? It's Brexit. We're literally months away from Brexit. Will it be a no deal, hard Brexit? Will it be an agreed deal Brexit? Nobody knows. And I'm not even going to try and predict to you which of those it's going to be. But what I can tell you is that Brexit's going to have an impact. Whether it's a hard no deal or whether it's with a deal, either way, the economists are predicting that Brexit will have a negative impact on our GDP and therefore will have a negative impact on our house prices. Let me show you some data that deals with Brexit. JP Morgan moves £200 billion of assets to Germany as it prepares for Brexit. The transfer of assets will make the US bank one of the largest in Germany based on the size of its balance sheet, according to Bloomberg News. Now, if you don't know, JP Morgan is America's largest bank, and it's got a history in the UK dating back to the mid-1800s, 200 years ago. London is currently its headquarters in Europe, the Middle East and Africa, but that's likely to now move to Frankfurt. Jamie Dimon, the chairman and chief executive of JP Morgan, said in 2016 that the bank could cut as many as 4,000 roles from the UK as a result of Brexit. At the start of this year, Jamie Dimon said a hard Brexit will be a disaster for Great Britain. We don't think it's going to happen because it's bad for Europe too. The economic cost of Brexit was laid bare in March by Britain's official budget watchdog, which warned that leaving the EU would dramatically hit growth, exports and public finance at a time when COVID-19 had already left the economy in unprecedented dire straits. If a typical free trade agreement is struck with Brussels, the Office of Budget Responsibility predicted a 5.2% loss of potential GDP over the next 15 years after Brexit. 5.2%. So will we leave the EU with a deal, or will we leave the EU without a deal? Like I said to you before, I'm not going to make a prediction on that. I have no clue. I don't think anybody in Brussels or in the UK has a clue whether that will happen or not right now. So I can't make a prediction, but what I do know is if we leave the EU with no deal, guess what? GDP is going to fall. That will knock onto house prices. And if we leave the EU with a deal, guess what? GDP is going to fall. That will knock onto house prices. So either way, Brexit is going to make us go backwards, and Brexit is going to make house prices go backwards. So what does this mean to the property investor? And have you got any good news for us, Aaron? Well, the good news is that the impact of this triad of things happening, the impact of coronavirus, the impact of unemployment, the impact of Brexit means for the property investor, the savvy property investor, the market's going to drop 5 to 10% in quarter four. In this next quarter, the market's going to drop 5 to 10%. Now, you might not hear that news until January or February because the reporting's always behind. But it's dropping, it's coming, we can see it because we see the underlying economics. We buy property deals off market and see the underlying economics. The thing I want you to get is, and this is probably the most important thing that I've shared on this video so far, is when that market's dropped, there's going to be about a 6-month window at rock bottom prices, at the bottom of the market. I'm talking about this window being gone by April, May, June 2021. I'm talking about the market starting to rise again then. Now, you're probably sat there going, how can that be possible, Aaron? We're going to have a longer recession than that. All those things you've just told me are going to lead to a longer recession. Well, do you remember right now we're in a bad recession, but the market's booming at the moment, isn't it? They don't always follow. They follow over time, but they don't always follow. And here's what's going to happen. Here's why the market's going to recover sooner. All that the property market will need is some green shoots. When we get to April, May and June, and we've been locked down for another 6 months, as is likely to happen soon, or we've been in different versions of lockdown anyway. When we get to April, May and June, and it's springtime again, and we want to move out and we want to come out, when more people have fallen in love and they want to move out and buy somewhere together, when more people have decided they don't like each other and they want to move out and they want to buy somewhere, guess what's going to happen to the property market? The property market doesn't need us to have a full recovery. Doesn't need us to fully come out of the recession. The property market just needs some green shoots. It needs a bit more certainty. It needs people to go, my business has actually survived. We're actually making some money now, or we're not losing money anymore. So we're going to be here longer term. Great, I can now keep my job. So now I can go move. I can go buy a house. So we're going to see the drop. We're going to see the impact. The impact's going to hit us. But then in 5-6 months, rock bottom prices, it's going to start to rise again. Now, I can't predict right now how fast it will rise. I don't have a crystal ball to predict that. And by the way, my predictions might be a couple of months out. It might fall in December or January instead of October, November. It might rise in June, July instead of April, May. I can't categorically tell you because there's so many moving parts. I've studied this. I've studied this for 2 decades now. I've lived in this for 2 decades. You may not even know. I've helped my clients buy over 1,300 properties in the last decade alone. I've got over 200 in my own. I understand the market. And my team are looking at £100 million worth of property every single year. Every single month. So we understand what's happening in the market right now today. We understand what's going on, and we see the off-market deals before everybody else. The off-market deals are ahead. The market's already dropped on the off-market deals. So it's coming. Be sure it's coming, and be sure there's a 6-month window that you need to take advantage of. You can't wait a year and then get on this game, because in a year's time, the market will be going back up again. Still great to get property at any time in the market, but what an opportunity to get hold of. So, what does this then mean for the property investor? Now we know when the market's going to drop, and now we know how long it's going to spend at the bottom. What does this mean? Well, this means you've got a decision to make. Do you remember earlier on I said to you, I was going to prove to you in this video series that anybody can build in 2 years a passive income of £50,000 a year from property, regardless of your starting point, regardless of the money, time or experience that you're starting with, provided you have the right education and training, you have the right support, and you have the right accountability. And in this video series, I'm going to prove that and show that to you, how everyday people just like you can do this. But what those everyday people have to do, what I had to do at the start of my journey, what you have to do at the next stage in your journey is you have to make a decision. I love Tony Robbins. You may or may not have come across him. He's a great mentor of mine, and I've done lots and lots of his training. But one of his great quotes, one of the favourite quotes that I have, it's in your moments of decision that your destiny is shaped. It's worth writing down. Pause the video, write it down. It's in the moments of your decision that your destiny is shaped. The decisions you make now will affect your financial future for generations to come. Not just your financial future, but your kids' because I'm talking about building something for you, a financial fortress for you that can make you $50,000 a year, but that will make your kids $50,000 a year, and the kids' kids, and the kids' kids' kids. So what decision will you make? Will your decision be to get on this opportunity? Will your decision be to upskill or do whatever you need to do to make sure you grab this opportunity? Or will your decision be to let it drift by? Or will you not make a decision? So you've listened to this video, and in my next video in this series, I'm going to share 3 other key parts that you have to get exactly right to optimize this. That's coming in a couple of days. But right now, what I want you to do is a couple of things. You've taken on this content. I'd like you to make a decision right now. And if your decision is that you're going to build a portfolio in the next couple of years, or add to your portfolio in the next couple of years, that makes you at least £50,000 of passive income, I'd like you to A, make that decision, okay? And then I'd like you to share it with your family and your friends. And you might say, I can't go to my family and tell them I'm going to make $50,000 a year in 2 years' time. Why not? You've got to share this to get the accountability. You've got to share this. And those friends and family that don't support you, by the way, maybe you need to change them. Because I want friends and family around me that when I say I'm going to do something and I commit to it, that they support the heck out of me, that they push me, they cajole me, they want me to achieve my goals. They don't ridicule me or have a problem with it. So I want you to make this commitment, make this decision, and write it down. You know, you've heard the studies, you've heard that when you write down a goal, you're 3 times more likely to achieve it than when you don't. Just by writing it down, if you never read it again, if you write it down and read it some more times, it goes to 8 times, 9 times, 12 times more likely to achieve it. So write down your goal right now. I want to grow an income, a passive income from property of 50,000, 80,000, 100,000 within the next 2 years. Write that goal down and then share it publicly with your family and friends. When we come back together in the next video in this series will be a couple of days away. When we come back in the next video, I'm going to share with you the 3 parts of what I call my key triad. The key triad that underpins all of your property investing. What are the 3 things that must be at the table with every property investment that you buy to guarantee this success, to guarantee this outcome? And I'll be sharing that with you in the next video. So watch out for my email, watch out for the next video in a couple of days. In the meantime, hope you've enjoyed this. Stay safe, look after those that you love, and invest with knowledge, invest with confidence, create financial freedom. I'll see you really soon.